Today we're dissecting something deeply counterintuitive that emerged from cryptocurrency exchange behavior patterns in 2025. The conventional wisdom would suggest that in a maturing market, dominant players lose ground. Instead, we witnessed precisely the opposite: concentration intensified. Consider this paradox: Binance's market share reached 42.3% by Q3 2025, up from approximately 30% at the start of the year. This defies standard industrial organization theory. In technology markets especially, network effects typically plateau. Competition erodes margins. Yet here, the Matthew effect accelerated during a period when 7 of the 10 largest exchanges experienced double-digit volume declines in Q2. This presents our first underwater information gap: market fragility creates concentration rather than dispersing it. The mechanism reveals something fascinating about liquidity as a moat. When Bybit launched zero-fee Bitcoin trading mid-2025, volumes surged 24%. But this wasn't sustainable competitive advantage. It was expensive user acquisition masquerading as strategy. The truly counterintuitive element? Binance could absorb offering free trading on Bitcoin for extended periods precisely because its scale allows revenue extraction from ancillary services. Smaller exchanges attempting zero-fee strategies were essentially subsidizing their own commoditization. Now, examine the institutional versus retail divergence. Coinbase's institutional volume reached 82% of total trading by Q2 2025. This is extraordinary. Most platform businesses optimize for volume and transaction count. Coinbase deliberately constructed a business where 82 of every $100 traded comes from institutions. Yet this created vulnerability disguised as strength. When crypto prices stabilized and volatility compressed in Q2, Coinbase saw trading volumes drop 43.7% quarter-over-quarter. Compare this to Binance's more diversified base showing resilience. The underwater insight: institutional concentration traded cyclical stability for structural brittleness. The on-chain ecosystem competition reveals perhaps the most tricky dynamic. Everyone launched Layer 2 networks. OKX had OKT chain. Bybit backed Mantle. Coinbase built Base. Binance ran BNB chain. Surface-level analysis suggested this was ecosystem building. But the divergent outcomes tell a different story. Base achieved over 1.2 million daily active users and $16.1 billion in total value locked by August 2025. Mantle had 12,000 daily active addresses. That's a 100x differential. The counterintuitive element isn't that Coinbase succeeded where others struggled. It's that Coinbase succeeded without a native token while OKX only achieved traction after radically burning 65 million OKB tokens and fixing total supply at 21 million, triggering a 208% price increase. This exposes the information gap: token economics matter less than friction reduction. Base succeeded because Coinbase integrated it seamlessly into its regulated US exchange interface. Users didn't need to understand Layer 2 architecture. They clicked a button. Meanwhile, Mantle required understanding separate wallet infrastructure, bridging mechanisms, and existed outside the core Bybit trading experience. The technological sophistication was inverse to adoption. August 2025 marked OKX's strategic inflection point. They eliminated their entire Layer 1 blockchain, consolidated everything into X layer, and implemented a supply shock by burning tokens to match Bitcoin's 21 million cap. Within days, X layer processed 2.05 million transactions in a single day, surpassing Ethereum itself. The transaction surge wasn't driven by utility. It was meme coin speculation. This reveals something profound about crypto-native users: they respond more intensely to scarcity narratives and wealth effects than to technological fundamentals. The truly underwater element? OKX's September 2025 derivatives volume exceeded Binance for the first time in history. Not through technological superiority. Not through lower fees. But through strategic tokenomics manipulation creating psychological momentum. This suggests that in cryptocurrency markets, financial engineering of platform tokens generates competitive advantages that operational efficiency cannot. Consider Bybit's February 2025 hack: $1.4 billion lost to the Lazarus Group. The largest cryptocurrency theft ever recorded. Conventional crisis management theory would predict catastrophic reputation damage, capital flight, potential insolvency. Instead, Bybit immediately processed 350,000 withdrawals, fully replenished all customer funds from reserves, and saw liquidity return to normal within 30 days. Bitcoin market depth on Bybit rebounded to $13 million. This is anti-fragility manifesting in practice. But here's the tricky part: Bybit's recovery wasn't purely from exchange reserves. Evidence suggests they drew from the $2.3 billion Mantle/BitDAO treasury, which saw a 15.9% quarterly decrease. Bybit effectively socialized losses across its ecosystem rather than absorbing them corporately. Users perceived this as strength. Economically, it represented undisclosed cross-subsidization between theoretically separate entities. The information gap, what appeared as balance sheet robustness, was actually liquidity fungibility across affiliated but supposedly independent structures. Now examine the revenue diversification paradox. Coinbase achieved nearly 50-50 split between transaction fees and subscription services by Q2 2025. This should represent business model maturity, reduced cyclicality, sustainable recurring revenue. Yet Coinbase's market position weakened relative to pure trading platforms. It fell from approximately 7% global spot share to 5.8% by July. The underwater insight: revenue diversification in platform businesses can signal growth ceiling rather than resilience. Coinbase subscription revenue largely came from 600,000 Coinbase One members paying $29.99 monthly for zero-fee trading. This is brilliant for extracting value from existing users. It's terrible for market share expansion. The most active traders, who generate disproportionate volume, rationally choose offshore exchanges offering lower base fees without subscription requirements. Coinbase optimized for profit per user at the cost of volume growth. This wasn't wrong, but it reveals a fundamental tension: you either optimize for depth or breadth, rarely both simultaneously. The compliance divide created fascinating second-order effects. Bybit obtaining a MiCA license in 2025 wasn't about European market access. Europe represents perhaps 7% of global crypto exchange traffic. The real prize was institutional legitimacy. But here's the counterintuitive element: Binance claimed 22 regulatory licenses globally by Q3 2025 yet faced ongoing regulatory pressure. OKX operated from Seychelles with selective licensing yet saw derivatives volume exceed Binance in September. This exposes the information gap: regulatory arbitrage remains more valuable than regulatory compliance for market share dominance. Compliance provides durability and institutional access. Non-compliance provides velocity and retail penetration. The optimal strategy isn't choosing one, it's operating dual structures that appear unified to users but remain legally separate. Binance's 22 licenses aren't centralized compliance, they're jurisdictional optionality allowing selective enforcement response. The AI integration pattern reveals another tricky dynamic. Bybit's TradeGPT reached 5 million users by 2025. OKX's AI trading bots attracted 480,000 users within 3 months of May 2025 launch. These numbers seem impressive. But examine what they actually represent: user interface improvements, not business model innovations. The bots don't generate direct revenue. They increase engagement metrics that might lead to more trading. This is the classic technology trap: optimizing for apparent sophistication rather than defensibility. The underwater element: exchanges investing heavily in AI features during 2025 were essentially admitting that undifferentiated trading infrastructure no longer creates competitive advantage. When your core product becomes commoditized, you add features. But features are easily replicated. None of these AI capabilities created moats. They created temporary excitement that normalized within quarters. Now consider the payment services convergence. Bybit's crypto card reached 2 million cardholders. Binance Pay processed over $230 billion cumulatively. OKX launched OKX Pay with zero-fee stablecoin transfers and 5% APY. These look like revenue diversification into payments. They're actually margin compression tools disguised as growth initiatives. Here's why this is counterintuitive. Payment services typically carry lower margins than trading. Visa and MasterCard make money on interchange fees ranging 1.5 to 3%. Cryptocurrency exchanges offering crypto cards with 20% cashback aren't building payment businesses. They're spending trading revenue to increase user acquisition costs while decreasing user stickiness because users rationally chase rewards across platforms. The information gap. These initiatives report impressive user numbers while destroying economic value. Bybit's 20% cashback attracted farmers, users exploiting rewards without genuine platform loyalty. This is algorithmic selection for your worst customers. High spend, zero retention, negative lifetime value. Yet exchanges continue these programs because monthly active user metrics look impressive to investors who don't distinguish between profitable engagement and subsidized activity. The decentralized exchange competition provides perhaps the richest counterintuitive terrain. DX market share reached 21.7% of global trading volume by 2025. Centralized exchanges responded not by improving their core offerings but by launching their own chains and integrating DX functionality. This seems strategically sound. It's actually an admission of existential vulnerability. Consider the logical structure. If DXs are genuinely superior for certain use cases, integrating them into your CEX interface accelerates user migration to on-chain trading. You're essentially training your users to not need you. But if DEXs aren't genuinely superior, why dedicate resources to building chains? This reveals the true information gap. Exchanges don't know whether centralized or decentralized models will dominate, so they're hedging by building both simultaneously. The resource allocation implications are staggering. OKX spent significant capital building OKT chain from 2021 to 2025, then abandoned it entirely in August to consolidate on X layer. Those were years and millions of dollars optimizing for the wrong architectural decision. But admitting the mistake and pivoting generated more value than persisting. This suggests that in rapidly evolving markets, the cost of wrong decisions matters less than the speed of recognizing and reversing them. BNB chain processing 3 million daily active addresses while maintaining DeFi utility represents Binance hedge executing successfully. But examine the mechanism. BNB chain's activity correlates almost perfectly with Binance's centralized exchange volume. It's not genuinely decentralized adoption. It's platform lock-in through token mechanics. Users hold BNB for trading discounts, then deploy it on BNB chain because they already have exposure. This is circular ecosystem design masquerading as organic decentralization. The truly underwater insight: successful exchange chains aren't winning because they're technically superior layer 1 or layer 2 networks. They're winning because they solved the cold start problem through bribing users with platform tokens earned from centralized trading. This is sustainable only as long as trading fees can subsidize chain development and liquidity incentives. When trading volumes compress, the entire model faces stress. Coinbase Space is the exception proving the rule. It achieved genuine external adoption with applications like FriendTech creating native demand. But note what Base lacks: a native token. This means Coinbase can't capture value through token appreciation. Transaction fees on Base burn ETH, not accrue to Coinbase. The strategic bet is indirect. Base usage drives new users to Coinbase for fiat on-ramps and off-ramps. But this creates peculiar incentives where Coinbase must maintain the most expensive part of crypto infrastructure, regulatory compliance and banking relationships, to support an ecosystem where value accrues primarily to Ethereum and Base application developers, not Coinbase itself. This exposes a fascinating tension. Base's success depends on Coinbase not extracting rent. But Coinbase is a public company with shareholder obligations. At some point, the pressure to monetize Base directly will intensify. The moment they introduce sequencer fees or attempt value capture, they risk fragmenting the ecosystem to competitors. This is the innovator's dilemma in blockchain form. The September 2025 data point where OKX derivatives volume exceeded Binance deserves deeper examination. This wasn't gradual market share gain. It was a single month where OKX processed over $1.3 trillion. The immediately preceding months showed standard patterns, with Binance maintaining leadership. What changed? The surface explanation, OKX's tokenomics and X-layer momentum created psychological tailwinds. The underwater explanation, Binance faced specific regulatory pressures in multiple jurisdictions simultaneously that month, causing large traders to diversify execution venues. But those traders didn't permanently migrate. Subsequent months likely saw reversion. This reveals that even dramatic single-month data points may represent temporary liquidity shifts rather than structural changes. The tricky element, both Binance and OKX reported these figures as validating their strategies. Binance emphasized year-to-date dominance. OKX emphasized monthly victory. Both interpretations were factually accurate and strategically misleading. This is how information asymmetry operates in crypto markets. The same data supports contradictory narratives depending on timeframe selection and metric emphasis. The proof of reserves evolution demonstrates another information gap. Binance completed third-party audited proof of reserves with Deloitte in March 2025. This was marketed as transparency triumph. But examine what proof of reserves actually verifies: that exchanges hold sufficient assets to cover liabilities at a specific moment. It doesn't verify profitability, leverage, affiliated entity obligations, or temporal asset movements. Bybit's February hack illustrates this precisely. They had proof of reserves showing solvency. Then lost $1.4 billion. Then remained solvent by accessing Mantle treasury funds. The pour was accurate both before and after, yet failed to capture the structural risk. This suggests that proof of reserves provides false precision, numerical certainty about assets while obscuring business model risks and interconnected liabilities. The counterintuitive implication: increased transparency through pour may increase systemic risk by creating common knowledge about reserve levels that sophisticated actors can exploit during stress events. If everyone knows exactly when an exchange's reserves dip, coordinated attacks become easier to execute. This is information's dark side. Common knowledge can be weaponized. Now consider the user acquisition cost dynamics. Exchanges spent aggressively in 2025 through zero-fee trading, high cashback cards, and token airdrops. Coinbase monthly transacting users fell from 9.7 million in Q1 to 8.7 million in Q2 despite these efforts. This reveals that user growth has become expensive and unreliable. The marginal user acquired today has higher cost and lower lifetime value than the marginal user acquired 3 years ago. This creates a profitability paradox. Exchanges must spend more to acquire users who trade less frequently with lower average volumes. The natural business response is increasing fees on existing users to fund new user acquisition, which accelerates churn among price-sensitive customers. This is a doom loop disguised as growth strategy. The underwater insight: exchanges reporting impressive registered user numbers face declining quality of user base over time. Binance claimed 290 million users by Q3 2025 is meaningless without understanding what percentage are active monthly, what percentage have deposits above $100, and what percentage generate positive lifetime value after acquisition costs. My strong suspicion, though unprovable with public data, is that fewer than 10% of registered users meet all three criteria. The institutional volume paradox deserves final examination. Global institutional trading reached 42% of exchange volume in 2025 versus 26% in 2023. This seems like market maturation. Sophisticated money entering. But institutions trade differently: lower frequency, larger size, more sensitive to execution quality, demanding custody solutions, requiring regulatory compliance. This isn't pure upside for exchanges. It's replacing high-margin retail flow with low-margin institutional flow. Coinbase exemplifies this: 82% institutional volume but struggling with overall profitability. The incremental revenue from institutional volume doesn't cover the incremental cost of institutional infrastructure, custody, compliance, customer service, insurance. This creates the perverse outcome where winning institutional business might decrease rather than increase economic returns. The information gap: institutional dominance that looks like strategic success may actually represent business model degradation. Retail traders accept high fees, tolerate poor execution, and generate profit through numerous small transactions. Institutional clients negotiate fee discounts, demand optimal execution, and generate thin margins on fewer large transactions. Growing institutional share without growing absolute retail volume means replacing profitable customers with break-even ones. This suggests the exchanges best positioned for long-term sustainability aren't those capturing the most institutional volume. They're those maintaining retail engagement while adding institutional relationships. Binance model, dominant retail base supplemented by institutional services, outperforms Coinbase model, institutional focus with declining retail engagement, precisely because retail margins fund the institutional infrastructure build-out. The final counterintuitive synthesis, 2025 validated that cryptocurrency exchanges operate under different competitive dynamics than traditional technology platforms. Network effects exist but concentrate rather than distribute value. Regulatory compliance creates costs without corresponding revenue growth. Ecosystem development consumes resources while remaining unmonetized. User acquisition costs rise as user quality falls. The exchanges that thrived weren't those with the best technology, lowest fees, most licenses, or largest user bases. They were those managing the fundamental tension between appearing legitimate to regulators while remaining accessible to retail traders, between building decentralized ecosystems while extracting centralized profits, between competing on price while maintaining margin discipline. The underwater information gap pervading this entire analysis, exchange success correlates weakly with operational metrics and strongly with narrative control. OKX's token burn created more competitive advantage than years of technical development. Binance's weathering of regulatory storms mattered more than its actual regulatory compliance. Coinbase institutional positioning generated market value despite degrading business economics. This suggests we've been analyzing the wrong variables entirely. Exchanges aren't optimizing for efficiency, user experience, or even profitability in traditional senses. They're optimizing for psychological positioning within a complex game of regulatory arbitrage, user psychology, and token economics. The winners master this metagame. The losers focus on fundamentals that fundamentally don't matter. That's the deepest counterintuitive insight from 2025. In cryptocurrency exchanges, appearance dominates substance because the product being sold isn't trading infrastructure. It's participation in collective narratives about the future of finance. The exchanges that recognize this explicitly structure everything: tokenomics, chain launches, regulatory positioning, feature development around narrative reinforcement rather than operational optimization. This explains why exchanges that should fail by traditional business metrics thrive, while exchanges executing traditional strategies correctly underperform. We're not watching businesses compete. We're watching narrative engines battle for mimetic dominance in markets where perception precedes and determines reality. That's the tricky underwater truth the 2025 data reveals once you stop accepting surface explanations and examine what actually drives exchange success beneath the metrics.